Now that count went up quick. And 8:30. Okay, we're gonna let a few more people come in. It's 8:30. We're gonna try and get this started as close to 8:30 as possible. For those that are in, thank you for showing up on time. If you can just tell me if you're happy to see that baseball is coming back, yes or no, and which team are you rooting for if yes. I just want to make sure you can hear me. Ellen likes the Dodgers. Anybody know that? That's Red Sox. All right. Amy's the Red Sox. Alan, I'm questioning some of our people right now. Okay. You Red Sox fans out there. I'm waiting for Rich Lafferty to show up. Phil with the Yankees. We got a lot of Yankees here, as it should be. I know, Ken, you're a Mets fan though.
Mm-hmm.
Okay, so we do have people are hearing us, which is good. We're up around 150 people in right now. It's still growing, but I do want to get this started because I know that people are going to have questions. Good morning, Courtney, and I want to make sure we get as much information to you as possible. So I want to welcome everybody. It's Thursday. Alan and I have blue shirts on. I have a sweater on, so it must mean PPP today. That's what it is. It's good to see you on a Thursday morning. Last time we got together, we talked about back to work stuff, information and nonprofit. It's been a couple weeks, but we've been waiting for information from the SBA and concise information. They finally came out with some over the past week and a half that we've been getting through, and even yesterday there's been more information that comes out, so we're trying to give you as much up-to-date information as possible. As we do every time we're going through the presentations, we're going to have 4 polls, which I'm going to put one up shortly. If you need CPE, you have to answer at least 3/4 of the polls, 3/4 of them to be able to receive credit. If you do try and answer the polls, there's something quirky and go to webinar, you have to take it out of full screen, minimize it, and then you're able to answer the questions. We found that out through a lot of emails back and forth with people saying that they can't answer questions. So hopefully it will work. I'll put one up in a second right after I recognize the presenters. If there are handouts, there's supposed to be 2 handouts up there. If you don't see 2 handouts, take down the one handout and let us know, and we can easily email you the other handout, but it will be the easy application and the actual presentation we will make available to you. Let's just do a poll real quick before I get to the presenters. When will you apply for forgiveness? I'm going to launch the poll. As soon as you guys get to either a minute, the earlier of a minute, or 90% of the people answering, I will close the poll. I will leave it up for adequate time for people to see the answers. Keep in mind, this is not a Quinnipiac poll. We're just using this to make sure people are on and awake. But we will share the information if you need it. Again, when do you plan on apply for forgiveness? 8 weeks, 24 weeks, still trying to figure out, and didn't take the money. This is a cool place to hang out. We are at 77%, and what's pretty much what I figured right now. Alan, I don't know if you can see, and Ken, if you can see the polls, 44% still haven't figured out if they're going to take it over 8 weeks or 24 weeks. 25%, and I'll close it down now because we're at 82%. I'll close it. You see that 21% said 8 weeks, 26% said 24 weeks, 43% said still trying to figure it out, and 11% actually said this is a cool place to hang out. So I don't know if it's me. I think it's probably our presenters. The 2 presenters that we have today are Ken Bagner and Alan Sobel. I'm not going to go through introducing them and their background. I'll just say that they are very versed in this topic. They've been reading up on it a lot and consulting clients either on and companies either on taking the loans, what to do with the money, and potential for paying back. So I'm going to jump right into Ken and let Ken go, and I will share my screen so you can see the slides.
Great. Good morning, everybody. Firstly, if you haven't taken the loan yet, you have till June 30th to take the loan. So you have a couple days left if you're last minute here. But having said that, I think the good news is it only took the government, I think, around 90 to 100 days to figure out most of the answers to the questions we have. There's still some open questions, but I think in the last clarity that they provided last week, I think we're now in a position to relatively know what to do with forgiveness. And some of the new things, and going through the updates to the application, when they passed Trump signed the new update to the CARES Act, there was concern that you had to spend at least 60% of your payroll, and if you didn't spend 60% of the money on payroll, then it would be all or nothing. That's the way the rule was written. But the SBA updated it and said basically, if you spent whatever you spend on payroll, you divide it up to get to a total number, and you can only have 40% more on other costs. And we're going to show an example of that as we go through to look at what that particularly means. But that gives a lot of flexibility not to worry about any sort of cliff rule. The other thing that's extremely, I'm surprised, and I'm thankfully surprised here, is that we weren't sure whether even though you had 24 weeks to spend the money, whether they increased the cap of how much you could spend. The cap originally was 100,000 divided by 52 weeks multiplied by 8 was the forgiveness, which was about $15,000. Now the new amount is over a 24-week period if you choose the 24-week period, which is $46,154 for most people, not everybody, which we'll talk about in a minute. Plus, you could add employer contributions for health, retirement, and certain state and local taxes. So now, when we go through an example, you'll see how the forgiveness will work and how much this can benefit if you choose the 24-week period. The only way I would recommend choosing the 8-week period is if you go through the process and you see that you're at 100% forgiveness. Otherwise, probably in most cases, maybe not every case, but most cases, the 24-week period is going to be the better period to utilize. Now, self-employed, general partners, and owner employees. So owner employees are defined as anyone, doesn't matter the percentage, anyone who owns an S corporation. You're limited to basically what you loaned out, which was $20,833. That was basically taking 100,000 cap, making it on a monthly basis, and multiplying it by 2.5, which you put on your loan application. You cannot take more than that for the owner group. Employees can go up to $46,154, but owners are only capped at $20,833. The other big thing that has changed is now the PPP loan, there's more flexibility on a payback if you're not forgiven, but hopefully everybody on this call has 100% forgiveness. It will go to 5 years on whatever your loan is remaining based on the portion that is not forgiven, and it's still at 1%. And you could choose, there's some questions before this webinar on the 8-week or 24-week period. You could use the 24-week period or 8-week period up to your choice if you took a loan before June 5th, 2020. Afterwards, you have to use the 24-week period. So that's some of the changes so far.
Hey, Ken,
yes.
The question that's coming actually from 2 people already, and I saw the Journal of Accountancy had an article out yesterday. So the question I'll ask very directly, another Ken said, in essence, do we have to wait the 24 weeks? So they can't do the 8 weeks because they wouldn't have spent the money, but they may have spent it in 10, 12, 13 weeks. Do they have to wait to the end of the 24 weeks, or they can apply in essence in the interim?
Yeah, I'm not positive about waiting for the, in between. I think you can, and I think you could accumulate it, but that's something I know that you could reply after the 24-week period is done at any time. Between 8 and 24 weeks, I don't know if anyone else has seen an interpretation on that, but I haven't seen anything at this point.
Yeah, and the if I find the Journal of Accountancy article, I'll send it over. But I think they were actually talking about applying earlier than the 8 weeks. It was really weird. They were cautioning on it, but
Yeah.
I didn't find anything. They're really just not being very clear on this stuff, and they're just saying, hey, you can go for 8 weeks or 24 weeks. It's like let's make a deal. They're not saying, they're only giving 2 boxes, and let's make a deal usually gives 3 interim, and I haven't heard that.
I haven't heard anything in between at all.
No. Okay.
But Brad, if I can, I'm not sure what the difference is. Once you get your amount, 100% to the point of forgiveness, it's not like you have to give the money back any earlier or anything on that order. So by waiting the 24-week period to make the application doesn't really hurt you in any way. It's just a timing issue. So I would get all your ducks in a row. I'd get everything completed as if you're, because you've got the 100% forgiveness. And if it does come out that you got to wait until the end of the 24 period, no harm, no foul.
Well, to some extent, just to be clear on that, it depends on your count, because if you're using a 24-week period, your count can go down and you can lose some of your forgiveness if you're laying some people off after the 8 weeks if you spent your money. We're going to go through an example of that in a minute just to discuss how it could hurt you. But to Alan's point, I think doing an analysis of it, and you'll see it in a minute, I think it's going to be a rare case that it would hurt you.
Yeah, and Mark actually said that too, that you've got, it's all about the FTEs that you have to watch for. Two things real quick. Somebody's already asking about nonprofit. I wanted to mention, for the most part, nonprofits and commercial are treated very similar with certain nuances. Government funding, you can't get double dipping, which we talked about in one of our last seminars, a nonprofit seminar, and if it's subject to UGG type of audit requirements, that there's special guidance on that we're not going to address here, but we can help you outside of that.
And Brad, nonprofits don't have business owners, so the restrictions that you have on compensation with business owners don't apply either.
And I think the reason that people are concerned about applying early, and Alan, you've said this many times, don't let the accounting tail wag the tax dog type of the business dog. People are concerned because they're gonna, if they don't apply early, they may still have a liability on the books at the end of the year. People don't want to have this liability on the books. They're worried about the accounting treatment. I'm not a fan of the accounting treatment, but to Alan's comment that I've heard him say many times, don't let the gap tail wave the business dog type of thing.
I think the hardest thing here is more, it's more from a standpoint of, from a tax standpoint, because if you come into extension time of next year and you don't receive notice that you're forgiven, how do you treat those expenses? Do you treat them as non-deductible? Do you treat them as deductible at that point in time? You probably have to go on extension, but you may have to make a payment at that point on non-deductible expenses, not knowing whether or not they're going to be deductible because you won't have forgiveness.
Right, because one of the questions Ken said, he didn't say this, but if he has to wait the 24 weeks, then he's got a 60-day review period by the bank and a 90-day by SB. It's 150. It's going to possibly put him after March and April 15th. And so now we're guessing at things. But all right, I'm sorry, I took you guys way off track, but that's me. You want to go to the next slide?
Yeah. So we're talking about why 24 weeks is so powerful. Generally 8 weeks, unless you have 100% forgiveness, and I have a couple clients that do, and they're going to be applying right away, that's fine. But the 24 weeks, we've seen mostly it's better. Forgiveness costs may well exceed the loan amount, and the total forgiveness is the lesser of the loan amount, forgiveness amount, or payroll divided by 0.6. So I'm going to show an example on the next slide of what that means, because I find that to be confusing. So let's just say we have payroll of $1 million, excluding other non-payroll costs. Other non-payroll costs are $300,000. So we took a loan of $1.3 million. Over a 24-week period, we have payroll of 1.7 and 300 of other costs. So we spent $2 million, well above the 1.3 million that we received. And we had a 30% reduction of workforce. We would take our $2 million of costs, assuming we had no drop under 25% of wages, and multiply by 70%, that's the forgivable amount, 30% is not, and we have 1.4 to be forgivable. Now, if you go to the next slide, Brad, you'll notice that 1.4 forgivable compared to 1.3 loan, compared to the payroll, which I took the payroll during the period and divided it by 0.6 to gross it up to what the lower amount would be. The lowest amount here is the loan amount, meaning 100% of the loans forgivable with a 30% reduction in workforce. Now, a lot of our clients may have kept their employees fully employed for the first 8 weeks. So I went down and calculated and said, well, how much would I have to be down in order to even be at 70%, which is still above the loan amount? And if I had 60% capacity or even a little bit less during the rest of the period, 16 weeks, I'd still be at 73%. And therefore, I'd still have 100% forgiveness. I could probably go down to around 52% or so and still have 100% forgiveness. So the point is to run your business the way you would need to run your business. If you spent the payroll and your business is down, you could go through the 24-week period if you still haven't had 100% forgiveness during the 8-week period. And even if you have a reduction in workforce, you still should be okay without even having to worry about restoration of the reduction. There's a safe harbor to get your employees back and have no reduction at all, which would bring you back up to the full $2 million of forgivable costs here. You could wait until you get up to that point and apply at any time after the 24-week period is over, which is on one of the next slides. But you may not have to if you have a reduction in workforce and you still have 100% forgiveness. So it is about crunching the numbers, but again, just from a practicality standpoint, I want everybody here to see that you can run your business the way you need to run your business with this 24-month flexibility, 24-week flexibility, because now you're really spending 24 weeks of payroll compared to 11 weeks of payroll, which you took the loan out on. So there's a lot of flexibility to get 100% forgiveness.
Now, Ken, I just want to say this example is just discussing payroll. There are other costs to consider too, right?
Oh, the other costs are in here actually. If you go to the prior slide, I put 300,000 in, and I said we spent a total of $1.7 million on payroll and 300 on other costs.
Okay.
Yeah.
Because I think somebody didn't see it on that slide and thought, oh, we're excluding them. So.
Yeah. It's just an example to show how powerful the 24 weeks is. That's one to show everybody. So if you're going to apply for 8 weeks, you better make sure you have 100% forgiveness. If you don't apply. Wait the 24-week period and apply afterwards.
As to that, Ken, I'm going to make a real stretch comment here, and please tell me if I'm wrong with this assumption. It seems to me if you're applying in 8 weeks, either you've had the same amount of payroll, but I'm going to probably see the people applying in 8 weeks are the easy applications for the most part.
Yeah, and we're going to get to what an easy application is, but that is probably correct. There are people who probably had even an increase in workforce. We have some clients that in every crisis, there's businesses that thrive and there's businesses that, do not thrive. And, some of our clients have thrived and some of them have not. So the ones that have and had an increased employees, that's an easier one to probably file an EZ, which we'll get to.
Right.
Other changes, updates to the application. This isn't the application. This is just a change in rule. If you're looking to get the 0% financing, basically on your 6.2% employer portion of Social Security taxes, originally it said once you were forgiven from your loan, you wouldn't be able to continue deferring that 6.2%. Now everybody can continue to defer the 6.2% to the end of the year if you're choosing that option, which means basically you're getting a 0% loan from the government and you're paying 50% of it back at the end of 2021 and 50% of that back at the end of 2022. You're going to have to make sure you account for that money because it does have to come back at some point in time, but it is 0% financing. And the other thing that's really important, and I want to mention for S corporations, health insurance is excluded, but it appears for the owners of S corporations in the instructions on the EZ form, retirement costs are eligible costs. They're limited to 24 out of, take your retirement costs, divide by 52 weeks, multiplied by 24. I'm sorry, multiplied by 2.5, divided by monthly and times by 2.5 months. They're limited similar to the $20,000 for the general partners that you're allowed to get based on your loan application, but you have 2.5 months of costs that for retirement benefits for owners that can be included. And it appears on the application, which is interesting, you could pay all your other retirement benefits, your 401k, whatever it is for the year if you have a full match, and that whole amount for the other employees will be included into the forgiveness calculation. So, you know, the only thing that's capped is the owner for 2.5 months. Everything else from the retirement cost standpoint can be paid through the covered period, which is your 24-week period.
Okay. So on that, real quick, we're going to jump to a polling question. Will you use all of the PPP funds in 8 weeks? Yes, no, going to 24 weeks / end of year, no, we'll never be able to fully use it, didn't take the money, just need the CPE credits. So if you can just answer that, and then Ken, as they're answering that polling, I will look over the questions. One said, what if we spent payroll in 8 weeks, but have money left? Can we elect 24 weeks and just pay rent over the next 16 weeks?
If you're not, it depends on your calculation with the, you know, payroll factor. As long as it doesn't exceed 40% of the other costs and
Right.
you get to 100% forgiveness, you might be okay. And it also depends on your FTE count, because if you don't have any employees, your FTE count goes down to 0 for the remaining 16 weeks. So you're going to have whatever your total pool is. If you have 0 and 100%, if I take 100 plus 0 plus 0 divided by 3, that's 33%. So you're going to have 67% reduction in your forgiveness unless you hire all your people back before you apply. So I guess it's in the details here, but you know, that's, you know, I'm not certain that's going to work as well as someone may think it would work.
And that's something that's big, Ken, because there's another question very similar to what you just said, and I have a client that's actually brought this up. This one says and I'm going to just share the results because people are getting upset. The forgiveness app is asking for a number of employees at the time of forgiveness. Okay, we spent our funds in 8 weeks and didn't lay anyone off. Excellent. But we did furlough employees after the 8 weeks. So will this affect us?
Now, it's not going to affect you if you apply and you have 100% forgiveness. You could apply for
weeks, though, right?
After the 8 weeks, you're okay. You may even be able to do the EZ form.
But if you go for the 24 weeks, you might have a problem.
Correct.
Yeah.
So if you have enough people in the 8 weeks, you've spent your money. If you know you have to lay people off, more than likely do it in the 8 weeks. There's a lot of other things to consider, but if in this one, I think it's Irina, you've used all your money, you've kept all your people, your FTEs are good at 8 weeks. If after 8 weeks you know you're going to lay people off, she might want to consider applying at 8 weeks.
Right.
Instead of
I point something out here that we've talked about on these programs before, which is 8 weeks is 8 weeks. It's not 2 months, or in this case, 2.5 months. So if you are looking for 100% forgiveness, effectively the only way you can get there is if your wages are substantially up during that period, that 8-week period, than they were on the measuring period. And so that's why you kind of have to crunch the numbers here. And you know, the goal is to get to 100% forgiveness, but you may not be able to get there if your FTEs are going down after the 8-week period than they were during the 8-week period. So you just got to be careful here. You got to run the numbers is really what it boils down to.
I agree. So, all right, Ken, safe harbors.
Yep. So there are some safe harbors here that are very helpful. Loan forgiveness reductions can be applied as of the date of the loan forgiveness application. So basically what that's saying is as of the date you submit your application, as long as you restore your employees, you're okay. So, and to me, I haven't seen how anything still that says that you have to restore them as of a particular time afterwards. It's like almost you could restore them for a week and then go back to whatever you want to do. I mean, I'm not suggesting that's the way to go, but it seems that's the way the literature keeps showing, and therefore you could pick and choose after your 8-week or 24-week period what you want to do based on your count being back. So if you had a reduction in the FTE count and you're down 50%, you hire somebody back and then put in the application for approval, it appears you'll have 100% forgiveness on the cost you spent. That's one of the safe harbors. Borrowers whose headcount will not, who throughout 2020 will not experience reduction amount provided the headcount was restored prior to June 30th or December 31st or earlier of the two. That's what we're talking about there. And you don't have to wait to December 31st to apply for forgiveness to use safe harbor. So when the 24-week period is over, and if there's any opportunity to apply between the 8 and 24-week, which is something we'll have to look at to see if we see anything additionally on that, you could apply and basically still have forgiveness and restoration if you had a lower account. So that's what the safe harbors are saying. So it looks like the SBA is really looking to make it easy to have a whole restoration in order for you to get forgiveness on everything you've spent. That's what they're trying to do based on getting your count back up.
Right.
Yep. And a couple other things. There's other bailout. Here's another one for basically anyone who gets their head count up, who cannot get their head count out before December 31st. Basically, if you couldn't rehire individuals that were eligible on February 15th, and the inability to hire those qualified employees for unfilled positions before December 31st, on or before, and that relates to directives or guidance from the Secretary of Human Health and Services and directors for Centers of Disease Control and Prevention and Occupational Safety and Health Administration during the period from March 21st to December 31st. So basically, you didn't rehire your employees back, and there was a reason why you couldn't get them back. Let's say the restaurants are still relatively closed down. That could be an industry, for example, that would make a difference here. They'll consider, even if you don't have the count back by December 31st, on or before, that you have all the costs you spent are forgivable. So here's another safe harbor to try to get your count up. Okay.
Payroll costs.
Yeah, payroll costs. We're still have the same payroll costs again. I'm not going to go through. Just U.S. employees with residence outside the U.S. don't qualify. Qualified sick family leave doesn't qualify. Remember too, this is separate from the slides, but if you receive $10,000 of a grant from the EIDL loan, that's going to have to reduce your forgiveness by the $10,000 you received.
And can payroll costs, payroll processing costs does not apply?
Correct, does not.
Okay. And 401k fees do not apply, administrative
Correct.
fees.
Does not
And
apply.
I'm going to give one more, although I'm happy that they pay it. The 401k audit fee does not apply.
Does not apply.
Okay.
Okay.
And
Non-payroll costs.
can I just jump in here for a second on payroll and just touch briefly, Brad, you talked about it very briefly at the beginning about nonprofits, and you indicated that basically these rules apply to nonprofits and for-profits, but this double dipping is an issue that doesn't have a lot of clarity right now, and there is a difference of opinions on how this will apply. Much like currently, the deduction for a for-profit enterprise will not be allowed for tax purposes if you don't pay the payroll costs, or if you get a forgiveness of the loan on the payroll costs. We think that is likely to apply as well to nonprofits as it relates to cost reimbursement programs. And in fact, last week the OMB released something and more or less said you can't double dip. If you receive federal funding on a cost reimbursement program, then you can, and you get PPP money, or you apply for PPP money, you cannot get that forgiven because the government has already paid you for it. You weren't harmed, so you wouldn't necessarily be able to get forgiveness. There's a little bit of confusion, or I shouldn't say confusion, lack of clarity as it relates to fee for service type things, where you have a fixed, you have a cost of operation, and then you bill the government for something and they pay you for those services, of whether or not you can then get forgiveness on that. And the only thing that I've really been able to find that might make sense on that is that when you develop your cost, you have to develop your cost of fee for services, If you didn't incur the payroll cost because it was forgiven as part of the PPP program, you may have to adjust your cost for fee of services. Now, that's beyond the scope of what we could talk about here today, and our nonprofit group will try to get more information out as it becomes a little clearer as it goes along. But that is one of the nuances as it relates to payroll. If you're getting federal funding, you may not be able to get forgiveness on that money that you're getting forgiveness on. And so some of the things you want to do is make sure that you, including in your application, those programs that are no longer being funded, those programs that never were part of funding, administrative payroll that would not be funded in the first place, all of those things that maybe that would qualify that are outside of direct reimbursement from the federal government.
I read something I was listening to Alan just on the Journal of Accountancy that says that you can apply early between the 8 and 24 week period if you want, but anything that you have as far as a reduction, for example, if you're paying someone less money and they're less than the 25%, they have more than a 25% reduction, it continues to move on and carry throughout the whole 24-week period. So you get penalized for the whole 24-week period. So it seems like there's an interim rule that may allow you to do that if you do have 100% forgiveness.
That was the article that I read last night, and my wife throughout this whole corona has avoided setting off the smoke alarm, and now she just set it off. So I just heard her running. I don't know if you guys heard that. Don't panic. It's my wife's cooking. Anyway.
That's funny. To go through the non-payroll costs, and just as a reiteration of this, they're for the mortgage, interest, rent, utilities, they have to be paid during the 24-week period, so you have to pay them. Incurred during the 24-week period and paid by its next regular due date, which means you could pay it after the 8 or 24-week period, but it could accrue back to the prior during the days that it counts during that period. So, if you're looking, and this may not be as relevant if you're really getting almost 100% forgiveness. You've got 24 weeks of payroll and 11 weeks of a loan. A lot of companies may not need even the non-payroll costs, but when you add them together, it's even more helpful to get you to 100% forgiveness. And another thing is, if you do not apply for the forgiveness, after 10 months after the covered period ends, that's when your loan is going to start. I haven't seen any clients tell me that they've restructured the bank loan agreements that they signed with the bank, that was provided through the original applications. But I'm sure at some point in time when these periods pass or when forgiveness comes by, at that point in time, the forgiveness there'll be a document to sign for the forgiveness. There'll be a document to sign for the new loan program. So your loan may say you're starting in 6 months from the date of the proceeds were received, but that's not the case. That has changed. Okay. Which application is right for you, easy versus full application? Brad, if you could move to the next slide here. Okay, so if you could check one of the 3 boxes on the easy application, and I stress one of 3, not all 3, you could apply for the EZ, which is a 1-page application. I will say though, even if you do an easy application and you have some of the circumstances here, you still have to submit the evidence of the circumstances. So it's not that you don't have to submit the documentation. The first thing is basically if you don't have employees and you're self-employed or independent contractor or sole proprietor. So no employees, everybody who has that can do an easy application. If you don't have that, you're really subject to 1 or 2 other qualifications. The first one is basically you haven't reduced anybody by more than 25% that makes $100,000 or less, and you haven't reduced any of your employees at all, excluding reductions arising from the inability to hire or rehire qualified employees. So basically, you have no reduction in your employee count. If you also haven't reduced the wages of anybody who's making less than $100,000 for any period, then you qualify to do an easy form because you don't have to go through all the calculations for reductions. The other thing here that it talks about is anyone who as an employee by more than 25%, their salary hasn't been cut as compared with the periods January 1 to March 31st, It must have been unable to operate during the covered period at the same level due to compliance with social distancing. So what they're saying here is the employee count may be okay if it's reduced and you haven't reduced anybody by more than 25%, but you'd have to not be able to operate. And what that really means may be subject to a little bit of interpretation. You'd have to go through what the ordering is, when that has ended. So for most people, they're going to still have to file the long form. But if you have circumstances where you basically had business as usual, you may be able to do the EZ application. And we have an example of what the EZ application looks like, which we're not going to spend a lot of minutes. If you just flip, that's just the general information, Brad. The 8 lines here, that's all this is. It just adds up all your costs. You have no reductions, and you compare your costs to your PPP loan to 60% of your payroll divided by 60 to gross it up, and the lower of the 3 basically gives you the forgiveness amount and you're done. But that doesn't mean you don't have to submit all the evidence that you didn't reduce employee count, that you didn't reduce anyone's pay by more than 25%. You still have to submit all that, so you can't just apply for the EZ application and say, I've done it. There's questionnaires too on there. There's a whole bunch of questions, and I think we may have that on the next slides, Brad, that go through the questions that they make you just check off on, which basically says that, you have all the information, you haven't, reduced anybody by the 25%, and you're, all the forms that you're signing off on acknowledges that you're not committing fraud or perjury or anything like that. You go through and check and initial all these questions, and that's basically you're done with the application. So the EZ application is a lot easier. The other application, which is the long form, which we'll go to, is condensed. Originally, the long form was 13 pages. Now it's only 5 pages, and we have that pulled up. If Brad, if you want to move to the next slide. So that's the general information that looks the same as the EZ. And then you go to the full application, the actual what it looks like. The first page is really relatively the same. You add up all your costs, but you have your reductions of wages, which get to your line 6. And then you look if you had any reduction in employee count, and then you multiply that out, and then you compare your amount that you're allowed to your actual loan, to your actual payroll divided by 60, basically to gross it up. And whatever the smaller of the 3 is forgiven. So that's how that works. And then behind it, you have the same questions, pretty much, but there's a change in 1 or 2 questions, but they're relatively the same. And then after that, you have the Schedule A, and the Schedule A basically is calculating out, and there's worksheets behind the Schedule A. It's calculating out, again, the reduction in full-time equivalents. It's calculating out your 25% reduction. It's also separating out, in addition, your employee retirement and health insurance, where if you're a partner in a partnership, you do not receive forgiveness for the employer health insurance. If you're a partner in a partnership, you don't receive the retirement payments. If you're an S Corp owner, you receive the retirement payments. So again, there's some things that are still very nuanced, but it's on this application, and it's on the instructions. And the last line 9 is the instructions for compensation to owners, which is separate from the people in table 1 that make under 100, and table 2 are the people who make over 100. And line 9 is the compensation to the owners that is listed out on the application. And then after that, you just have the back schedules, which you're going to have to calculate, everything related to the, forgiveness based on reductions. So again, for most people, they still probably going to have to, most companies are going to have to do the full application. But if you have circumstances where you really haven't laid anyone off, you may be able to do the EZ, but you're still gonna have to fill out all this information anyway to prove that you could do an EZ. So I don't know how much easy it is. It's easy from the standpoint of filling out the 1 page, but it's not an easy process.
Nothing's ever easy, Ken.
Nope.
So I'm going to put up a polling question, and there were a couple questions that came in. So will you use the EZ application? Yes, no, still considering, didn't take the money. I like sweater Thursdays. So somebody asked a question, one of our employees passed away in January. We replaced them in March. Will that count as a reduction in employees? It's not a person for person, the actual individual. It's just full-time equivalent head count. Correct, Ken?
Correct. So you're okay that person will count, and you'll be able to replace the person who unfortunately passed away.
Okay, somebody asked what the covered period is, and I know that this was addressed when you did the last application. I don't know if you want to give some background.
The covered period is the period that you're paying out your forgivable costs, whether it's the 8-week period, the 24-week period, or if you stop in between the 8 and 24-week period, which appears that there's authority to do. Whatever your period is from the date that you receive funding of the loan to the date your 24-week or 8-week period is over, or something in between that you're applying for, whatever that covered period is, that is your covered period in order to calculate your forgivable costs.
Okay. So we've had this question come up a bunch of times, and I see it came up again. Terminating an employee for cause. First of all, if you let's go through if for some FTE questions that have come up a lot. You know, we had the 25%. If you've offered people back their jobs and the attorneys have said put it in writing, then it counts as an FTE, correct?
Correct.
Now, the problem that I think that we're going to have, and this is speculation, this is the comments that are made herein are my own and not necessarily those of Sobel and Company. What I think that is going to happen is that unemployment is going to say, hey, did you offer these people back their jobs? Yes, we did. Why didn't they come back? Because they said the job wasn't available. So all of a sudden the businesses are going to now become the police for the unemployment, but that's speculation.
Yeah, I think, you know, again, we talked about this in a little bit of, we had a separate session for some of our clients who received 2 million plus, which are going to be audited. And the ones that receive under 2 million, quite frankly, whatever you hand in all your backup documentation, they're going to be processing this like they processed the mortgage back years ago during the mortgage crisis, I think. And they just kind of went through it and went check, 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 check. Everything's there, and they're going to put it through. That's my opinion on the way that most of these are going to work, because it's just there's so much volume that's going to show up that's going to be difficult to really review the data. Now that's not saying that there will be circumstances that won't happen, but in generality, I'm guessing that's going to happen. On the 2 million plus loans, there's 25 million allocated to audit these costs, and we divided it by the amount of loans, and it gives the SBA and the government 45 minutes per loan to review. Now, I don't know what's going to happen there and how they're going to figure that out. That's an interesting thing and to be determined. But the question really is if you have your file in place, do they look and just say, everything's here, we're good, and move forward? The case may be that. We don't know, but it's very likely based on the volume.
So they can do an audit in 45 minutes. They must not use AICPA checklist. What was that, Alan?
Not to over analyze the situation or create any kind of fear, but I will tell you that, you know, the mortgage crisis situation in 2008, they are still investigating the inappropriate use of that money, and here we are in 2020. So, you know, our advice is do it right. There's plenty of room within this program to do the right thing and to not find yourself, you know, having to go under the scrutiny. It's better to do it right. Even if you leave a couple of dollars on the table, you're just going to be able to sleep well at night and not have to worry about, you know, anybody giving you a proctology exam. If there are any doctors on here, sorry for that, but, you know, about your PPE money.
Yeah, we're very concerned about that too. And, you know, here's another thing where it's kind of getting concerning, and I don't know what the disclosure will be. Whether you're audited, not audited, that's one thing, and what it will say based on whether they say you're fully relieved, but who knows? On the over $2 million, you get everything forgiven, right? And then you go and spend the money afterwards, and then all of a sudden you get an exam later on again, and they say, you know what, we gave you forgivable costs here, but we believe that that was incorrect. Who knows? Who knows what can happen? That's the thing that is scary, to not know, whether or not they could go back, and what is the statute on this to go back and actually come back and ask for funds back. I don't know. Nope.
Ken, as you know, we discussed this briefly yesterday. They're going to be publishing the names of companies that have received this money. And right now they're limiting it to the name and I think they're putting them into buckets as to the size of the loan, is what the Treasury said. But under the Freedom of Information Act, it's very possible that some reporter decides to do an expose on the PPP program and is able to get information. And you don't want to be, it's bad enough if my in an article, you certainly don't want to be, chastised for doing something inappropriate. So do the right thing here. I think that's really the bottom line.
Now, Alan, I know that you've either dealt with this or we've talked about this in different ways, especially as it relates to clients, about terminating people with cause. Okay. I believe that if they're terminated with cause, they can still be counted as an FTE. But what is with cause? Is performance cause? Of course, we know the typical ones: committing a crime and doing certain inappropriate things. But is performance deemed a cause?
So again, nobody really knows for sure. My viewpoint, the way that we're approaching it, is if somebody is not performing well, that is for cause, as opposed to laying them off just because, or furloughing them because we don't have sufficient work. You don't want to have you don't want to keep people that are underperformers on your payroll. That doesn't help the process or anything on that order. And while you don't get credit for their payroll, you also don't get, you shouldn't get dinged on the FTE side of things for reduction because you make a business decision about letting somebody go because they're not performing. Now, you should have documentation of that. You should make sure that your files are able to support that, should that be scrutinized down the road. And it may be that, the SBA or whomever's auditing this may have a different opinion. There's some legal aspects to cause as well, but I would suspect that if somebody's not performing, that would be something that would not ding you on the FTE side.
Now, if you pay somebody severance, I imagine the severance is included in the payroll costs.
That's right. But you have to be careful if you give them a lump sum, right? You might, as you annualize that, it might actually show that they get greater than $100,000, which may limit it as well. So again, be mindful of how you're doing it. I think the flip side is also true, is that if you continue to pay them over time, if they apply for unemployment, they will not be able to get it because they're getting wages from you. Whereas if you give it to them in a lump sum, then it doesn't count towards their unemployment. So you're kind of balancing, you're balancing those two competing things as it comes to severance.
Yeah, well, it's interesting because Phil and I've read a lot about this. The people who are over $100,000 on the cap, it says per payroll period. So someone could be over the $100,000, and that's kind of a strange thing because you give them a large lump sum, whether it's a bonus or whatever it may be. And I don't think anyone in the application is going to put people who make under 100 in the over 100 category just because they gave them a bonus to try to maximize out the PPP funding. It says nothing about doing a large amount during a period being capped for that particular period. The only thing it shows is on a macro level that you can't be over the $45,000 for the 24-week period or the $15,000 if you use the 8-week period. So it's a very strange, the way they word it, they still haven't clarified nuances. I think to Alan's point, like there's no clarification on some of these things, but I think generally people are going to take employees who generally make less than 100 and put them on the less than 100 table, and over 100, when over 100, and they're going to ignore the payroll by payroll. That one payroll may be over 100 annualized. Just there's no clarification at all.
Yeah, and I mean, and I don't want to keep going down the road of cause, but because some of the questions now start to get crazy. Of course, somebody said if an employee is socially reckless, which I'd never heard that, but I like that phrase now, socially reckless. I mean, what I would strongly recommend up front is talking to an attorney. I don't know what socially reckless is unless, Alan, you know, and don't you say, Alan, Brad, that's you. But but if you're seeing things like that, you might want to talk with an attorney to determine if it's with cause. You've identified that they've been a poor performer for a long time. That's different. But
but I would say, Brad, that if you as a company set policies about social distancing and responsibility in the workplace, and somebody is continuously violating that, and you have brought that to their attention, you give them the appropriate warnings. If they're violating policy, just like if they violated other policies, that would, and again, I'm not a lawyer, so I yield to legal scholars on this, but it would seem to me that that would qualify for cause, so long as you follow the proper protocols of notification, you have a clear policy, and you document that in your files.
Right. So we have a bunch of questions still, and I'm watching the time on the 25% and the 100% and stuff like that. I just want to give us a breather for a second and ask something off topic. Transportation, have they defined that yet? That's what I thought. I'll still go with Michael.
But Brad, I think it becomes less relevant. Ken has made this point. When you're dealing with 24 weeks of payroll, if you're a company that definitely has a significant reduction in workforce, then this may take on a different meaning. But if you think about it, it was 8 weeks that were supposed to be forgiven. 2.5 was your loan, right? So theoretically, if you now have 8 weeks and you get to another month of payroll, and under 24 weeks, that gives you far more than that. You have the ability to basically get everything written off. So I don't think that transportation, if you're down to that, then it means you had probably a significant reduction in your workforce along the way. So we can get caught up in a lot of these nuances here, but the extension to 24 weeks of payroll really does mean that most people are going to be able to get 100% forgiveness if it's appropriate.
Yeah, and people who don't have payroll, or companies that don't, they're not going to have forgiveness because it's your payroll costs, and then your non-payroll can only be 40% over that. So if you have $1 of payroll, you have basically like 30, 40 cents or whatever it works out to be of non-payroll costs. So you have to spend on payroll in order to have the non-payroll costs.
And another non-payroll question, prepayments. So we do have some, I don't think it's going to be a lot, but let's say they prepaid telephone costs or some other utilities in November, and it goes to November, but this November, if they try and prepay again, it's going to fall outside their 24 weeks. What do you do in that situation? Because it wasn't paid, it was incurred, but it wasn't paid during the period. It was paid before the period.
They prepaid before the covered period. The only thing you could do now is prepay again, unfortunately. Or I'm not suggesting this, you ask for a refund and then pay again, which is probably not the right thing to do. We want everybody to do the right thing here, but you may have to pay even further out. But whatever you pay during the period is allowed. So on the non-payroll costs, and again, to Alan's point and the point that we brought up before, if you're scratching at this, obviously you probably don't have a lot of payroll, so that's one of the things, and you still have to balance the 60-40 rule, which is better than the old 75-25 rule, but still will provide limitations on the non-payroll costs.
Right. So I'm going to run one more poll, and a lot of the questions are coming in now, especially regarding payroll, which is what you can expect, because now that we're up to the 24 weeks, that's what it's going to be impactful. S Corp S Corp shareholder distributions does not qualify, or was that changed?
They do not that's irrelevant. It's based on your earnings, not your distributions. So it's not what you draw the company. It never has been. Right.
I didn't think they changed that. I saw somebody type it, and I just wanted to make sure that, and I may have misread their question, but I'm trying to read through them quick. So as it relates to the 25%, I'll ask the question and I'll put the next poll up. I'll just say what it's going to be. What topic do you want to hear next? What the next poll is going to be? But Ken, for the next next couple of questions, the impact of reducing the wages 25%. Is the reduction based on hourly rate, or is it a person's gross wages? So a person may make more because they're working overtime, but we had to reduce their hourly rate. Is it just the gross wages? And what happens if you restore by year end, but after your 24 weeks?
Okay, so the first question, it all is just based on gross numbers. So overtime, unfortunately, could hurt you if you're not doing overtime now. and you could have more than 25% reduction. That's absolutely possible. You have to restore the wages by 12/31 or the earlier the date of the application, whichever is earlier for forgiveness. If you restore afterwards, after 2020, the only way you'll be able to get out of not having a reduction is if you had what we talked about before, the inability to hire back people based on governmental restrictions, which we listed out in one of the previous slides.
Okay.
And Brad, you show your bias on that poll. How come you didn't ask whether they want to hear a tax topic? Why just A&A? Exactly.
By the way, who was it? Okay, Alan, thanks for calling me out. Jane said, is the PPP and EIDL taxable revenue? I did read just revenue, and I'm like, yes, A&A, but it's taxable. She did say.
It's not taxable revenue, so that's the distinguishment. It's the expenses that are forgivable or non-deductible.
Right.
So the money that comes in is non-taxable, but the expenses are not deductible, so it's really revenue neutral. We were hoping to have a situation where the money came in and then the expenses were not, the money was not taxable and the expenses were deductible as well. Who knows? We could have another patch that could happen. So, you know, we have time now between now and next year's tax filing time. So it's possible, and there's been some congressmen who have been pushing for that. But I was hoping on the last bill that the Trump just signed on the enhancements of the CARES Act that it would be in there, but it was not. So I'm giving less hope for it to happen.
Right.
And there's that nuance, well, Ken, right, towards self-employed individuals who actually don't deduct their cost, but the forgivable amount is not income. So if you're self-employed, it will not be taxable for that piece of it.
For now. We're waiting. I mean, there could be a regulation where they catch on to that. Any S corp, you know, any you know, owners from an S corp, from an owner, from a partnership, sole proprietor, whatever, anyone who's self-employed, they're all going to have that situation where there's you know, potentially some of the costs. From an S corp standpoint, you already get the deductions, so you won't have that situation. But definitely on a partnership, you'll have that, or sole proprietorship.
Yeah, the one of the questions that had been coming up, and I'm going to merge a couple of them together. This one was interesting. Use 100% of funds, okay, but don't have 100% of employees. Do I get 100% of forgiveness?
Potentially, because did you use 200% on forgivable costs? On the example we went through earlier, I think we had a loan of 1.3 million, but we spent 2 million, right? So, and then we had a 30% reduction that got us to 1.4 million of forgivable costs, net. We only received 1.3, so 100% was forgivable. So if you spent exactly the amount of the loan and you had a reduction in headcount, you're still going to have a reduction of the loan, of the amount, and you're not going to have everything forgivable unless you restore your employees. But the point is, most likely, even if a lot of our companies tried to pay through the funds during the 8-week period to expend them. So they probably had mostly full employment. Not everybody did, but a lot did. And in the example I laid out, even if you went down to like 52% for the next 16 weeks, you still probably have about 100% forgiveness. And that's not even looking fully and closely at the non-payroll costs. We look partially by throwing some in an example. So the point is, you could run your business the way you want to run it going forward, the way you have to run it, because you're not going to have the dollars anyway. If the revenue is not coming in and you spent the dollars that you received, and you got to make choices for your business that's right for your business and move forward. And even if you make those choices, you probably most likely will still have 100% forgivable under these more flexible rules on a 24-week period.
Right. Now, if you have employees that you were out for maternity or out for disability, but they're not, can they be part of FTEs?
Yes.
Are you
Yes.
paying them?
Well, you're not paying them, but they're not, you're not getting the first credit, sorry, for Family First credit. You're not taking that either. So they're just out on regular disability or family leave.
Yeah, I think they still count.
Well,
That's
they their wages don't count, right? They're not included in your payroll, but on the FTE side, the thing is they will count. Even a
Yeah,
They're
voluntary.
still an employee.
I don't think you have a reduction of under 25% either on that case either. You know, it's not like there's two tests, there's the FTE test and 25% reduction.
Okay. So we are at the right at the hour mark, and there's a couple of things that came up. I want to give you guys a second for closing comments, but there's a lot of questions that have come up. There's people that ask many repetitive questions, or they ask a lot of questions themselves. So I try and get everybody to hopefully get a question in, but we we'll look over the questions and send some information out. The one thing that I will say that now I get to do a presentation, Alan. I will be very brief. There is accounting guidance out now as to the accounting treatment for the loan. I'm happy to talk about this offline. I have a strong opinion of this too, but I won't share that here. But I will say that the loan has to be carried as a liability in full until the SBA signs off and gives you clearance that you have whatever the forgiveness is. It is form over substance here, regardless that the obligation may have been satisfied. You cannot eliminate the liability until the SBA actually signs off on it. And then nonprofits will be treated as grant income, and commercial will be treated as other traditional forgiveness of debt. That's my summary of A&A. By the way, I always put the last polling question as a goof, so that's why I put A&A there.
So on that note, Brad, I guess if you have any companies here who have an issue with debt to equity ratios, they should look closely at this and probably have someone from our firm reach out and work with them with the bank to make sure the bank fully understands that they are probably going to be forgiven, so they could have a waiver of that in advance.
I was going to say that, more than likely, it's a foolish comment to make, but more than likely, they got the PPP from their bank that they have their normal lending relationship with. But I'm looking at my client's name on the screen, and I know they had to go to another bank because their bank wasn't offering it. So there could be situations. So I'm going to put up your contact information. But Ken and Alan, I'd like to hear if you have any closing comments.
Ken, why don't you go ahead?
Yeah, I think a couple of things. One, generally patience is fine here. Some people may want to apply and believe they have 100% forgiveness. Once you apply, you're going to be locked in. So I just say be patient on this. There's not a rush. You could go through the 24-week period as long as you think you're going to keep your employee count relatively up. Then 24 weeks generally is probably the better methodology to apply for. And the other thing that we talked about is just make sure you do the right thing. And the right thing means, from a standpoint of dotting every I, crossing every T, and doing everything that is required to be done. And as Alan said before, I think if there's something that's questionable, you may be questioned on this afterwards. So I think in the scheme of things, for most people, it's not even going to be relevant because you're going to get 100% forgiveness. So it's better to be a little bit conservative on this. And, and we're here to help. And if you have more questions, we'll, go through, and you could call anyone who you work with at the firm or call Alan, myself, and we could go through with you any more questions that you have. And we're going to answer the ones that you post with Brad. We do that after every seminar. Things we have not answered, we will answer.
All right.
And I just emphasize one thing that Ken said, and that is hindsight is 20/20. And what you want to be able to make sure is that under the scrutiny of a microscope, with the advantage of everything being looked back, through that that rear view mirror, that you've done everything right. And I don't want to lose sight of the one element that we haven't talked about today, and that is your rationalization for taking this loan in the first place. And so if you haven't prepared a business case yet as to why you took the money down, it's not too late, because you may not remember in 3 years ago why that happened, and business may be good, right? Turn around and be good, and you're going to be asked, why did you take this loan? Again, that doesn't seem to be a problem, at the moment. There are, the rules seem to say that if you're not going to get scrutinized if you meet certain criteria. But my suggestion is back it up, do your business case, document it, and stick it in a file, because someday you may need that. And then last but not least, Ken touched on the deferral of taxes, the payroll taxes, which is a great cash flow item, should help you with reducing potentially bank debt that you would have otherwise. But don't lose sight of it, because you're going to have to pay that in 2021 and 2022, and make sure it's part of your cash flow models. And Brad, that would be a liability that you have to record on your balance sheet. So I know that makes you happy.
Oh, no, why would I like liabilities?
You just like recording things.
That's true. You got me so excited. You talked about a journal entry. Anyway, I want to thank everybody for attending. I want to thank Alan and Ken for presenting on this. This is a never-ending changing topic in the way that you and the two of you and Mark and Chris and the other team members stay on top of this. I want to thank you all for what you've done with this. We will get answers out to you on many of the questions we can, and watch for next week to see if we'll have a webinar. We like to have the topics timely and relevant. So thank you everybody again, and have a good day.
Thank you. Be well, everybody.